Hello and welcome to the Tellone Perspective. I'm Dean Tellone. For 50 years, I've been helping clients navigate their financial lives. We've talked about careers, we've talked about taxes, and today we are going to talk about the topic that seems to be on everyone's mind right now: real estate. Where is the housing market headed? Are prices going to crash? Are interest rates ever going to come back down to 3%? Should you buy now or should you wait? I get these questions every single week. And I understand why. A home is usually the largest single purchase a person will make in their lifetime. It is the foundation of most families' net worth. When the market feels uncertain, it creates a lot of anxiety. Today, I want to cut through the noise. We are going to look at the actual data, where interest rates are, what is happening with housing inventory, and how historical cycles can help us understand exactly where we are right now. No hype, no panic, just a straightforward analysis of the market. Let's start with the elephant in the room: interest rates. For the last couple of years, the real estate market has been essentially frozen. We experienced what economists call the lock-in effect. During the pandemic, millions of homeowners refinanced or bought homes at historically low rates, 2.5%, 3%, maybe 3.5%. When rates jumped up past 7%, those homeowners looked at the math and said, "I'm not moving." Why would you trade a 3% mortgage for a 7% mortgage if you didn't absolutely have to? You wouldn't. So, nobody sold. Inventory dried up and the market ground to a halt. But here is what is happening right now in 2026. That lock-in effect is finally starting to break. Current data shows that about 1 in 3 home sellers today are giving up a mortgage rate below 5%. Why? Because life happens. People get married, they have children, they get divorced, they change jobs, they retire. You can only put your life on hold for a mortgage rate for so long. Eventually, the need for a different house outweighs the desire to keep a low rate. As for where rates are headed, the consensus among major forecasters like Fannie Mae and the Mortgage Bankers Association is that 30-year fixed rates are likely to hover in the low 6% range for most of 2026. I need to be very clear about this. We are not going back to 3% mortgage rates anytime soon. Those pandemic-era rates were an anomaly, an emergency measure by the Federal Reserve to keep the economy afloat. Historically speaking, a 6% mortgage rate is actually quite normal. If you are waiting for rates to drop back to 3% before you buy a house, you might be waiting for a very long time. So, if rates are stabilizing in the 6s and people are finally starting to move again, what does that mean for housing inventory? This brings us to the second major factor: supply. Right now, we are seeing inventory rise. In many markets across the country, the number of homes for sale is up roughly 20% compared to a year ago. That sounds like a big jump, but we have to put it in context. In real estate, we measure inventory in months of supply. This means if no new homes came on the market, how many months would it take to sell all the current homes at the current sales pace? A balanced market, one that doesn't favor the buyer or the seller, is typically considered to be a 5 to 6 month supply. Right now, nationally, we are sitting at about a 4.5 month supply of existing homes. So yes, inventory is rising. You are seeing more for sale signs in your neighborhood. But we are still technically in a market that leans slightly toward the seller, simply because we have a structural shortage of housing in this country. For over a decade following the 2008 financial crisis, builders simply did not build enough homes to keep up with population growth. That deficit doesn't disappear overnight. Now let's talk about the question everyone really wants answered. What is going to happen to home prices? To understand where prices are going, it helps to look at history. Economist Homer Hoyt famously identified an 18-year real estate cycle that has held remarkably consistent for over 2 centuries. The cycle has 4 phases: recovery, expansion, hypersupply, and recession. During the pandemic, we were in a massive expansion phase. Prices shot up 40% nationally in just a few years. That kind of growth is unsustainable. Today, looking at the data, most major U.S. markets appear to be transitioning from late expansion into early hypersupply. Inventory is rising, and price growth is slowing down. In fact, Zillow's latest 12-month forecast predicts that national home prices will be essentially flat, 0% growth, between now and early 2027. But remember, real estate is intensely local. There is no single U.S. housing market. There are thousands of local markets, and they are behaving very differently right now. In parts of the Northeast and the Midwest, places like Syracuse, New York, or Rockford, Illinois, prices are still forecasted to rise by 4 or 5% this year. These areas remained relatively affordable during the pandemic boom, and they are still seeing steady demand. On the flip side, look at the Sun Belt. Markets that exploded during the pandemic, places like Austin, Texas, or New Orleans, Louisiana, are seeing prices pull back. In some of those overheated markets, prices are forecasted to drop by 3 to 7% over the next year. So, what does all this mean for you? How should you navigate this market? First, if you are a buyer, the frenzy is over. You no longer have to waive all your contingencies and bid $50,000 over asking price within 2 hours of a house hitting the market. You have more choices now. You have time to negotiate. But you have to accept that a 6% interest rate is the current reality. Marry the house, date the rate. If rates drop significantly in the future, you can always refinance, but don't put your life on hold waiting for a market condition that may never return. Second, if you are a seller, you need to adjust your expectations. It is not 2021 anymore. You cannot put a sign in the yard on Friday and expect 10 offers by Monday. Your house needs to be priced correctly, it needs to be in good condition, and you need to be prepared to negotiate. The buyers who are out there are dealing with higher borrowing costs, and they are being much more selective. Finally, whether you are buying or selling, remember that real estate is a long-term investment. I bought my office complex in Anaheim Hills back in 1992. Over the last 30 plus years, I've seen markets boom, I've seen them crash, and I've seen them stagnate. But over the long haul, real estate has consistently proven to be one of the most reliable ways to build wealth and hedge against inflation. The market we are in right now is not crashing and it is not booming. It is normalizing. It is returning to a more balanced, sustainable pace. And frankly, after the roller coaster of the last few years, a boring, normal real estate market is exactly what we need. Thank you for joining me today. I hope this analysis gives you a clearer picture of where the market stands and helps you make informed decisions for your own financial future. I'm Dean Tellone, and this has been the Tellone Perspective. I'll see you next time.